Hello, and a very warm welcome to all the hustlers out there tuning in today. This is the Full Time Hustler Podcast, your go to place for all things entrepreneurship. We're here to peel back the layers of startup culture, uncovering the raw, the real, and the revolutionary. Whether you're brainstorming your first venture, knee deep in the trenches of your startup, or scaling to new heights, this podcast is your beacon in the entrepreneurial wilderness. I'm your host, Jason Feimster, and I'm thrilled to have you join us for episode number 32, titled Financial Fitness Money Management for Entrepreneurs. In today's world, where the only constant is change, managing your finances as an entrepreneur isn't just an important skill, it's a vital lifeline. The journey of an entrepreneur is fraught with uncertainties, and your ability to navigate these with financial acumen can make the difference between your business thriving or merely surviving. Today, we're zeroing in on the art and science of financial management, tailored specifically for you, the entrepreneur. We'll explore strategies, tools, and insights designed to not just safeguard your business's financial health, but to propel it into a realm of growth, sustainability, and success. As we gear up to dive deep into the world of financial fitness, set the stage for what's to come. Managing your money isn't just about tracking expenses or making payroll. It's about crafting a vision for your business and steering it towards financial success. It's about setting and achieving goals that are not just ambitious, but also attainable, realistic, and time bound. From understanding the basics of budgeting to mastering cash flow, from exploring revenue diversification to wise investment strategies, we're covering it all. And let's not forget, the Full Time Hustle podcast is more than just a source of information. It's a community. It's a place where entrepreneurs come to learn, share, and grow together. So, as we embark on today's journey into financial fitness, I encourage you to engage, reflect, and apply these principles to your own entrepreneurial endeavors. Remember, financial management for entrepreneurs isn't just about surviving the next quarter, it's about thriving for years to come. So, whether you're listening in from your office, your home, or on the go, get ready to transform the way you manage your finances. Let's build those financial muscles and ensure that your business is not just fit, but financially robust. Now, let's dive into the first segment where we'll explore what financial fitness means for you, the entrepreneur, and why it's the cornerstone of not just your business's success, but your peace of mind and future prosperity. Understanding financial fitness for entrepreneurs. When we talk about fitness, the first thing that might come to mind is physical health, strength, endurance, and overall wellness that allow us to perform our best. Financial fitness for entrepreneurs holds a similar essence, but in the realm of business. It's about having the strength and resources, the endurance and sustainability, and the wellness and profitability to navigate the entrepreneurial journey with confidence and foresight. What is financial fitness? Financial fitness for entrepreneurs is the state of being in which your business finances are healthy, allowing for growth, scalability, and resilience against economic fluctuations. It means having a clear understanding of your financial position, being proactive about financial management, and making informed decisions that align with your business goals. But why is financial fitness particularly critical for entrepreneurs? Unlike established corporations with vast resources and cushioning, startups and small businesses operate on thinner margins. This reality makes them more susceptible to financial missteps. A financially fit business can withstand downturns, capitalize on opportunities, and sustain growth over the long term. Components of financial fitness. 1. Budgeting and expense management. At the heart of financial fitness is the ability to create and stick to a budget. This means knowing your income, understanding your expenses, and ensuring that the latter never outweighs the former. It's about being mindful of where every dollar is going and ensuring that your spending aligns with your strategic goals. 2. Cash flow management. Cash flow is the lifeblood of any business. Being financially fit means having a steady flow of cash to cover your operational needs, pay employees, invest in growth opportunities, and handle unexpected expenses without resorting to detrimental financial options. 3. Debt management. Smart debt management is crucial. It involves understanding the difference between good debt that can generate income and increase net worth, and bad debt that does not offer returns and can diminish financial health, and managing it to leverage growth without overburdening the business. 4. Savings and investment. A financially fit business not only manages its current finances well, but also plans for the future. This includes having savings for emergencies and making wise investments in assets or opportunities that can offer returns and contribute to the business's long term financial health. 5. Financial planning and analysis. This involves regularly reviewing financial statements, understanding the financial metrics that matter, and using this data to make informed strategic decisions. It also includes tax planning, ensuring compliance, and optimizing tax liabilities. The importance of financial fitness. Being financially fit empowers entrepreneurs to make strategic decisions with confidence, seize opportunities as they arise, and navigate challenges with resilience. It lays the foundation for sustainable business growth, attracting investors, building a reputable brand. Financial fitness is not just about surviving, it's about thriving, expanding, and achieving long term success. In essence, financial fitness for entrepreneurs is about more than just numbers. It's a mindset, a strategic approach to business that emphasizes financial health as a key component of overall business success. It requires discipline, foresight, and a commitment to continuous learning and improvement. As we move forward in today's episode, keep in mind that financial fitness is attainable. With the right tools, strategies, and mindset, you can ensure your business is not just surviving, but thriving, ready to take on the challenges and opportunities that lie ahead. Setting financial goals. As entrepreneurs, we're often caught up in the whirlwind of day to day operations, innovation, and chasing the next big thing. However, amidst this hustle, it's crucial to pause and reflect on what we're aiming for financially. Setting financial goals is not just about numbers, it's about defining the direction and purpose of your entrepreneurial journey. Let's delve into how setting precise financial goals can serve as the compass guiding your business towards long term success and sustainability. Short term versus long term financial goals. First, it's important to distinguish between short term and long term financial goals. Short term goals are typically those you aim to achieve within a year. These can include launching a new product, increasing monthly sales by a certain percentage, or even reducing operational costs. On the other hand, long term goals focus on where you want your business to be in 3, 5, or even 10 years. These might involve expanding to new markets, building a robust emergency fund, or achieving a specific net worth for your business. Both types of goals are essential. Short term goals help create momentum and tangible progress, while long term goals ensure you're working towards a bigger picture, keeping you aligned with your ultimate vision. Examples of financial goals for entrepreneurs. Let's look at some concrete examples. A short term goal could be improving your business's cash flow by 20% over the next 6 months. This is specific, measurable, achievable, relevant, and time bound. Smart. A long term goal might be to grow your business to a point where it generates a specific annual revenue, say 1 million, within the next 5 years. Another critical long term goal for many entrepreneurs is to establish a retirement plan. Unlike traditional employees, entrepreneurs need to be proactive in planning their retirement, considering options like solo 401k or a simplified employee pension SEP IRA. Importance of SMART goals. The SMART criteria are fundamental when setting financial goals. Each goal should be specific, clearly define what you want to achieve, measurable, ensure that you can track your progress, achievable, be realistic about what you can accomplish, relevant, make sure it aligns with your overall business objectives, time bound, set a deadline to keep yourself accountable. By adhering to these principles, your financial goals will serve as clear markers on your path to your business's success. They not only help in measuring progress, but also in motivating you and your team to push boundaries and achieve more. In conclusion, setting financial goals is a final step for entrepreneurs aiming for long term success and stability. It requires a balance between short term achievements and long term aspirations, all while keeping the goals smart. By clearly defining these goals, you lay down the roadmap for your financial journey, ensuring that every step you take is a step toward your ultimate vision of success. As we wrap up this segment, I encourage you to take some time after this podcast to reflect on your financial goals. Are they smart? Do they align with your long term vision for your business? Remember, these goals are not set in stone, they're meant to evolve as your business grows. So set them, pursue them, and be ready to adapt them as your entrepreneurial journey unfolds. Budgeting for business success. After setting our financial goals, it's time to talk about the backbone of financial management, budgeting. Budgeting isn't just about limiting expenses, it's about empowering your business to allocate resources wisely, ensuring that every dollar spent is an investment in your company's growth and stability. Let's break down the essentials of budgeting for business success. The essence of budgeting. At its core, budgeting is about planning. It's a fast forward looking process that involves understanding your income, predicting your expenses, and setting aside funds for both expected and unexpected opportunities or challenges. For entrepreneurs, a well structured budget is your roadmap, guiding financial decisions and strategies throughout the fiscal year. Starting with revenue forecasting. First step in creating a budget is revenue forecasting. This involves estimating how much money your business will make over a certain period, typically a year. It's crucial to be realistic and base your projections on historical data, market analysis, and current trends. Overestimating your revenue can lead to overspending, while underestimating can hinder your growth opportunities. Categorizing and planning expenses. Once you have a revenue forecast, the next step is to categorize and plan your expenses. Fixed expenses, such as rent, salaries, and utility bills, are predictable and consistent. Variable expenses, on the other hand, such as marketing costs, inventory purchases, and maintenance, can fluctuate based on business activity. It's also wise to allocate funds for unexpected expenses, those unforeseen costs that can suddenly arise. The rule of thumb is to set aside a portion of your revenue, around 5 to 10%, for an emergency fund. The importance of a contingency plan. In addition to an emergency fund, a contingency plan is an integral part of your budget. This involves outlining steps to take in response to potential financial shortfalls or unexpected costs. Having a contingency plan ensures you're prepared to navigate financial hurdles without derailing your business operations or compromising growth. Utilizing budget tools and software. Technology has made budgeting more accessible and efficient. Numerous budgeting tools and software are designed specifically for small businesses and entrepreneurs. These tools can automate many aspects of budgeting, from tracking expenses and forecasting revenue to generating financial reports. Leveraging such tools can save time, reduce errors, and provide insights into your financial performance. Regular review and adjustment. A budget is not set in stone. It's a dynamic tool that should evolve with your business. Regularly reviewing and adjusting your budget is essential. This allows you to respond to changes in your business environment, capitalize on new opportunities, and mitigate risk promptly. A monthly or quarterly review is a good practice, enabling you to compare actual performance against your budget and make necessary adjustments. In conclusion, budgeting is a critical process that underpins the financial health and success of your business. It's about making informed decisions, planning for the future, and ensuring that your business resources are used efficiently. By forecasting revenue, planning expenses, and preparing for the unexpected, and utilizing budgeting tools, you can create a robust financial plan that supports your business goals and drives success. As we close this segment, I encourage you to reflect on your current budgeting practices. Are they in line with your financial goals? Do they provide the flexibility to adapt to changes? Remember, effective budgeting is about strategic planning, and it's never too late to refine your approach for better financial management. Revenue streams and diversification. Having navigated through the importance of budgeting, it's time to pivot towards a crucial strategy for financial resilience and growth: diversifying your revenue streams. In today's rapidly changing market, putting all your eggs in one basket is not just risky, it's a recipe for volatility. Let's explore how diversification can safeguard and elevate your business. The power of diversification. At its heart, diversification is about spreading risk. It's the financial equivalent of not relying solely on one source for your survival. For entrepreneurs, this means creating multiple revenue streams so that if one falters, others can sustain and propel your business forward. Diversification is not just a protective strategy, it's a growth strategy, opening up new avenues for expansion and innovation. Identifying new revenue streams. The first step in diversification is to identify potential new revenue streams. This could involve expanding your product line, offering new services, or finding novel ways to monetize your business's assets and capabilities. For example, a software company might diversify by offering consultancy services, while a retail store could launch an online marketplace. An excellent example of this strategy in action is Amazon. Initially an online bookstore, Amazon diversified into selling a wide variety of consumer goods. Before expanding into cloud computing services with AWS, Amazon Web Services, which now represents a significant portion of its revenue, leveraging your core competencies. Effective diversification leverages your business's core competencies. It's about finding synergies between your current operations and potential new markets or products. For instance, a restaurant known for its unique sauces might bottle and sell these sauces as a separate product line. This not only opens up a new revenue stream, but also enhances the restaurant's brand and customer engagement. The role of market research. Successful diversification requires thorough market research. Understanding market demands, customer needs, and competitive landscape is crucial. This research will guide you in identifying viable new revenue streams that are aligned with your business's strengths and market trends. Tools like SWOT analysis, strengths, weakness, opportunities, threats, can be instrumental in this process. Strategic partnerships. Another path to diversification is through strategic partnerships. Collaborating with other businesses can offer mutual benefits, including access to new markets, shared resources, and enhanced product or service offerings. For instance, a tech startup might partner with an established enterprise to offer a bundled product, thereby tapping into the enterprise's customer base. Managing the risk. While diversification has its advantages, it's not without risk. Spreading your resources too thin or venturing into areas outside of your expertise can backfire. It's essential to manage these risks by taking a measured approach, starting small, and scaling up based on success. Also, engaging with experts and consultants in the new market or product area can provide valuable insights and guidance. In conclusion, diversifying your revenue streams is a strategic approach to building a more resilient and robust business. By exploring new markets, leveraging your core competencies, conducting thorough market research, and forging strategic partnerships, you can create a diversified revenue portfolio that not only mitigates risk, but also unlocks new opportunities for growth. As we wrap up this segment, take a moment to consider your business's current revenue model. Are there untapped opportunities you could explore? How could diversification drive your business forward? Remember, in the dynamic world of entrepreneurship, adaptability and innovation are key to thriving. Managing cash flow. Diving directly into the lifeblood of every business, cash flow management is a topic that cannot be overstated in its importance. Cash flow, simply put, is the movement of money in and out of your business. It's about timing, ensuring that your inflows match or exceed your outflows to keep your business not just surviving, but thriving. Effective cash flow management is essential for day to day operations, from paying your employees to purchasing inventory and covering every expense in between. Understanding cash flow. To manage your cash flow effectively, it's crucial to understand the difference between profit and cash flow. Profit is what remains from sales revenue after all expenses have been subtracted. However, profit does not equal cash in hand if those sales are on credit. Cash flow, on the other hand, is the actual cash that's available to your business at any given time. Positive cash flow means you have more money coming in than going out, which is the goal for sustainable business growth. Forecasting your cash flow. Forecasting is the starting point for managing cash flow. It involves predicting your future cash inflows and outflows over a specific period. This forecast helps you anticipate periods of cash surplus or shortage. allowing you to make informed decisions about paying debt, reinvest, reinvesting in your business, or saving money. A detailed cash flow forecast includes all expected receipts from sales, accountable accounts receivable, etc., and payments, including suppliers, salaries, rent, etc. Improving cash flow. There are several strategies to improve your cash flow. 1. Invoice promptly and follow up. Detailed invoicing leads to delayed payments. Ensure you're invoicing as soon as goods or services are delivered. Implementing an efficient follow up process for overdue invoices can also speed up cash inflows. 2. Manage inventory efficiently. Too much inventory ties up cash unnecessarily, while too little can lead to stockouts and lost sales. Using inventory management tools can help optimize your stock levels. 3. Extend payables without penalizing relationships. While it's beneficial to delay outflows, it's essential to do so without harming supplier relationships. Negotiate longer payment terms where possible, but always honor agreed terms to maintain trust and reliability. 4. Use technology. Leverage technology to streamline your cash flow management. Online invoicing, mobile payment solutions, and cloud based accounting software can provide real time insights into your financial position, helping you make quicker, more informed decisions. Dealing with cash flow challenges. Even with the best planning, cash flow challenges can arise. Economic downturns, unexpected expenses, or slow sales can strain your cash flow. Here are a few ways to navigate these challenges. Access to credit. Establishing a line of credit before you're in a cash crunch can provide a safety net. Cost reduction. Review your expenses regularly to identify areas where you can cut costs without sacrificing quality or growth potential. Revenue diversification. As previously discussed, diversifying your revenue streams can stabilize your income and, by extension, your cash flow. Cash flow management is not just about monitoring the money that flows in and out of your business. It's about strategic planning for the short and long term. By understanding your cash flow, forecasting accurately, improving cash inflows, managing outflows, and being prepared to tackle challenges, you can ensure your business remains financially healthy and ready to seize opportunities as they arise. Investment and reinvestment in your business. Investment and reinvestment are cornerstone strategies for fostering growth and sustainability in any entrepreneurial venture. Understanding how, when, and where to reinvest your profits can significantly influence your business's trajectory. This segment delves into the nuances of making informed decisions about investing back into your venture, ensuring that every dollar you reinvest contributes to its long term success. The importance of reinvestment. Reinvesting profits back into your business is a testament to your commitment to growth and sustainability. It's about using your earnings to improve and expand your operations, whether through upgrading technology, expanding your product line, enhancing marketing efforts, or investing in your team's development. Reinvestment is the fuel that propels your business forward, enabling scalability and improved competitiveness. Strategic reinvestment areas. 1. Technology and innovation. In today's fast paced market, staying ahead technologically can offer significant competitive advantages. Investing in the latest technology, whether it's new software to streamline operations or advanced manufacturing equipment, can enhance efficiency and product quality. 2. Talent development. Your team is your most valuable asset. Investing in training and development not only boosts productivity, but also enhances job satisfaction and retention. Consider leadership training, technical skill upgrades, even wellness programs to support your team's growth. 3. Market expansion. Expanding into new markets requires careful planning and investment. This could mean geographic expansion or diversifying into new customer segments. Market research, marketing campaigns, and potentially even new hires with expertise in these markets are essential investments for successful expansion. 4. Product or service diversification. Developing new products or enhancing existing offerings can open up additional revenue streams. Investment in research and development is crucial for innovation. ensuring your offerings remain relevant and competitive. 5. Operational efficiency. Streamlining operations can save costs in the long run. Consider investing in process improvements, quality control, or supply chain optimization. These investments can lead to better margins and more sustainable growth. Measuring the return on investment, ROI. Before making any significant reinvestment, it's vital to consider the potential return on investment, ROI. ROI measures the efficiency and profitability of an investment and can help you prioritize where to allocate your resources for the best impact. Analyzing past investments and their outcomes can provide valuable insights into future investment decisions. Balancing reinvestment with financial health. While reinvestment is crucial for growth, it's essential to balance it with maintaining your business's financial health. Ensure you have adequate working capital to cover operational costs and any unforeseen expenses. It's also wise to set aside a portion of profits for emergency funds or as a financial buffer. Leveraging external funding for investment. In some cases, your reinvestment needs may outstrip your available profits. This is where external funding options such as loans, investors, or grants can play a role. Utilizing these funds strategically can accelerate growth, but it's important to carefully consider the terms and implications of any external financing. Investment and reinvestment in your business are not just about spending money. It's about strategically deploying resources to areas with the highest potential for growth and return. By focusing on technology and innovation, talent development, market expansion, product diversification, and operational efficiency, you can ensure that your reinvestment decisions propel your business toward long term success and sustainability. Understanding and managing debt. In the entrepreneurial journey, debt is a tool that, when used wisely, can help scale your business to new heights. However, mismanagement of debt can lead to financial strain or even failure. This segment focuses on understanding the role of debt in business, how to manage it effectively, and strategies to leverage debt for growing while minimizing risk. The role of debt in business. Debt financing involves borrowing money that must be paid back over time with interest. Unlike equity financing, which involves selling a portion of your business, debt does not dilute your ownership. It can be a powerful tool for funding expansion, improving cash flow, or purchasing essential equipment. The key is to use debt strategically for investments that will generate returns exceeding the cost of the debt. Types of business debt. 1. Term loans. These are traditional loans with fixed repayment schedule over a set term. They're ideal for large, one-time investments in your business. 2. Lines of credit. Offering flexibility, lines of credit allow you to borrow up to a certain limit and pay interest only on the amount borrowed. They're useful for managing cash flow fluctuations. 3. Equipment financing. This type of loan is specifically used to purchase equipment, with the equipment often serving as collateral for the loan. 4. Merchant cash advances. Although not technically a loan, this is an advance based on future credit card sales and is typically used by businesses that need quick access to cash. Effective debt management strategies. 1. Understand the terms and conditions. Before taking on debt, ensure you fully understand the terms, including interest rates, repayment schedule, and any potential penalties for late payments or early repayment. 2. Use debt for growth driving investments. Borrow for purposes that will enhance your business's value and generate revenue, such as expanding operations, entering new markets, or investing in marketing. 3. Maintain a healthy debt to equity ratio. This ratio measures your company's financial leverage. A balance between debt and equity financing is crucial to maintain financial health and investor confidence. 4. Regularly review and consolidate debt. Periodically review your debt obligations to identify opportunities for refinancing or consolidation. This can lead to lower interest rates and reduced monthly payments. 5. Build a strong credit history. Paying your debts on time improves your credit score, which can lead to better terms on future loans. A strong credit history is a valuable asset for any business. 6. Emergency planning. Always have a contingency plan to manage debt during downturns. This could include having an emergency fund, cutting non essential expenses, or restructuring debt. Leveraging debt for business growth. Strategically taking on debt can accelerate growth in several ways. Investing in expansion. Use debt to finance new locations, product lines, or market entry strategies that would be impossible through cash flow alone. Capitalizing on opportunities. Debt can provide the funds to capitalize on timely opportunities such as bulk purchasing inventory or at a discount or acquiring a competitor. Enhancing operations. Borrowing to invest in technology or processes that improve efficiency can reduce costs and increase profitability over time. Debt is a double edged sword in the realm of entrepreneurship. Managed wisely, it's a powerful tool for growth and expansion. However, it requires a disciplined approach to financial management, clear understanding of your business's financial health, and a strategic vision for its use. Remember, the goal is not just to grow faster, but to build a sustainable, financially healthy business that thrives in the long term. Saving and planning for the future. As entrepreneurs navigate the complexities of running a business, focusing on the present is often a priority. However, saving and planning for the future are equally crucial components of financial fitness. This segment delves into the importance of forward looking financial strategies, offering actionable advice on saving, investing, and preparing for both opportunities and uncertainties that lie ahead. The importance of saving. Saving is not just about setting aside money for emergencies, it's also about building a foundation for future investments and growth opportunities. A robust savings plan enables entrepreneurs to weather economic downturns, seize unexpected opportunities, and plan for long term goals without jeopardizing their business's current operations. Creating a savings plan. 1. Emergency fund. Aim to save at least 6 months worth of operating expenses. This fund acts as a financial buffer, ensuring you can cover unforeseen costs or survive downturns without taking on additional debt. 2. Set clear financial goals. Define specific, measurable, achievable, relevant, and time bound, smart financial goals. Whether it's expanding your business, launching new products, or saving for retirement, having clear goals guides your saving and investment strategies. 3. Automate savings. Automating transfers to a savings account removes the temptation to spend and ensures consistent growth of your savings over time. Investing in the future. Investing is a step beyond saving, involving the allocation of resources into assets expected to generate returns over time. For entrepreneurs, investing can take many forms, from reinvesting in their own business to diversifying into stocks, bonds, or real estate. 1. Reinvesting in your business. Often the highest returns can come from investing in your own business, whether it's through marketing, product development, or expanding your operation. Carefully consider how reinvestment can drive growth. 2. Diversification. While reinvesting in your business is crucial, diversifying your investments can reduce risk. Consider a mix of stocks, bonds, real estate, or other investments to protect against market volatility and sector specific downturns. 3. Retirement planning. Entrepreneurs often overlook retirement planning, but it's a critical aspect of long term financial health. Options like a self employed 401k, SEP, IRA, or simple IRA can offer tax advantage savings and compound interest over time. Planning for the future. 1. Succession planning. Regardless of your stage in the entrepreneurial journey, it's essential to have a plan for the future of your business. Whether it's passing the business on to family members, selling it, or transitioning to new leadership, having a clear succession plan ensures the longevity and sustainability of your enterprise. 2. Insurance. Adequate insurance coverage, including life, disability, and business interruption insurance, can protect you and your business from unforeseen events, ensuring that your financial plans are not derailed by emergencies. 3. Estate planning. Finally, estate planning is crucial for ensuring that your assets are distributed according to your wishes and that your business's legacy is preserved. Saving and planning for the future are integral to achieving financial fitness as an entrepreneur. By building a robust savings plan, making strategic investments, and preparing for both opportunities and uncertainties, you can ensure the long term success and sustainability of your business. Remember, the decisions you make today will shape your business's future and your financial legacy. Tax planning and management. Tax planning and management are critical components of financial fitness for entrepreneurs. Effective tax strategies can significantly impact your business's bottom line, saving you money and ensuring compliance with tax laws. This segment offers insights into navigating the complexities of taxes, optimizing your tax situation, and leveraging tax planning as a tool for financial health and business growth. Understanding your tax obligations. The first step in tax planning is understanding your specific tax obligations. Taxes vary widely depending on your business structure, sole proprietorship, partnership, LLC, corporation, etc., the nature of your business, and the jurisdictions in which you operate. Familiarizing yourself with the relevant tax laws and regulations is crucial to ensuring compliance and avoiding penalties. Strategies for effective tax planning. 1. Keep accurate and detailed records. Meticulous financial records are the foundation of effective tax planning. Keeping accurate records of income, expenses, and deductions throughout the year can simplify tax preparation and maximize your eligible deductions. 2. Understand and utilize deductions. Many entrepreneurs miss out on valuable tax deductions simply because they're unaware of them. Common deductions include business expenses, home office expenses, travel and entertainment, and equipment depreciation. Consult with a tax professional to ensure you're leveraging all available deductions. 3. Consider the timing of income and expenses. Timing can significantly affect your tax liability. By strategically deferring income to the next year or accelerating expenses into the current year, you can manage your taxable income and potentially lower your tax bill. 4. Make use of retirement accounts. Investing in retirement accounts not only helps secure your financial future, it can also offer tax advantages. Contributions to accounts like a SEP IRA, solo 401k, or simple IRA can reduce your taxable income. 5. Stay informed about tax law changes. Tax laws and regulations are constantly evolving. Staying informed about changes that affect your business can help you adapt your tax strategy and take advantage of new tax benefits. 6. Employ tax credits. Tax credits, unlike deductions, reduce your tax liability dollar for dollar. Take advantage of tax credits for which your business is eligible, such as those for research and development, energy efficiency, or employment of certain groups. The role of tax professionals. While understanding the basics of tax planning is essential for every entrepreneur, the complexity of tax law often necessitates professional advice. A qualified tax professional or accountant can provide tailored advice, identify tax saving opportunities, and help navigate audits or complex tax situations. Tax planning as a year round activity. Effective tax planning is not a once a year activity, but a continuous process. Regularly reviewing your tax situation and making adjustments throughout the year can lead to significant savings and prevent the scramble often associated with tax season. This proactive approach allows for strategic decision making that aligns with your business goals and tax optimization strategies. Tax planning and management are indispensable for maintaining financial fitness as an entrepreneur. By understanding your tax obligations, employing strategic planning, and seeking professional advice, you can minimize your tax liability, ensure compliance, allocate more resources toward growing your business. Remember, a well thought out tax strategy is a powerful tool in your financial fitness arsenal, enabling you to navigate the complexities of taxation with confidence and ease. Financial health checkups. Regular financial health checkups are a critical practice for entrepreneurs, serving as the equivalent of a routine physical exam for your business. Just as a regular health checkups can detect and prevent issues before they become serious, financial checkups can uncover potential problems, opportunities for growth, and areas for improvement in your business. This segment dives into the importance of regular financial review and analysis, key financial metrics every entrepreneur should monitor, and the tools and resources that can facilitate these vital checkups. The necessity of regular financial review and analysis. A regular financial review involves a comprehensive analysis of your business's financial statements, including the income statement, balance sheet, and cash flow statement. This process helps entrepreneurs understand the financial health of their business, track progress towards goals, and make informed decisions. Conducting these reviews monthly, quarterly, and annually ensures you are always aware of your financial position and can adjust your strategies as needed. Key financial metrics every entrepreneur should monitor. 1. Cash flow, the lifeblood of any business. Cash flow measures the net amount of cash being transferred into and out of a business. Positive cash flow indicates that a company's liquid assets are increasing, enabling it to settle debts, reinvest in its business, pay expenses, and provide a buffer against future financial challenges. 2. Profit margins. Your profit margin, both gross and net, reveals the percentage of revenue that exceeds your cost. Tracking these margins helps assess the financial health and efficiency of your business, indicating whether you're pricing your products or services appropriately and controlling costs effectively. 3. Debt to equity ratio. This ratio compares your company's total liabilities to its shareholder equity, providing insight into the financial leverage and risk level of your business. A high ratio might indicate excessive debt, while a lower ratio suggests a healthier balance between debt and equity financing. 4. Accounts receivable turnover. This metric measures how efficiently your business collects on outstanding credit extended to customers. A higher turnover rate indicates efficient collection processes, crucial for maintaining healthy cash flow. 5. Inventory turnover. For businesses that sell physical products, this ratio helps gauge the efficiency of inventory management. It measures how often inventory is sold and replaced over a period. A low turnover might indicate overstocking or sluggish sales, while a high turnover can suggest strong sales or insufficient inventory. Tools and resources for financial health checkups. Leveraging technology can significantly streamline the process of conducting financial health checkups. Several tools and resources are available to help entrepreneurs monitor their financial metrics effectively. 1. Accounting software. Platforms like QuickBooks, Xero, and FreshBooks offer powerful features for tracking expenses, managing invoices, and generating detailed financial reports. These tools automate much of the financial review process, providing real time insights into your business's financial health. 2. Dashboard tools. Tools such as Microsoft Power BI or Tableau can integrate with your accounting software to create customizable dashboards. These dashboards visually display key financial metrics, making it easier to monitor trends and make data driven decisions. 3. Financial advisors and accountants. While technology can automate and simplify financial analysis, the expertise of financial advisors and accountants is invaluable. These professionals can provide personalized advice, help interpret financial data, and recommend strategies to improve financial health. Regular financial health checkups are indispensable for entrepreneurs aiming to maintain and improve their financial fitness of their business. By consistently reviewing your financial performance, monitoring key metrics, and utilizing the right tools and resources, you can identify opportunities for growth, address potential issues early, and make strategic decisions that drive your business forward. Remember, a proactive approach to financial management is key to building a sustainable and successful business. Takeaways, key points recap. As we wrap up this comprehensive journey through financial fitness, money management for entrepreneurs, let's take a moment to revisit the pivotal insights and strategies shared throughout the episode. Each segment offered a deep dive into the crucial aspects of financial management, aimed at empowering you, the entrepreneur, with the knowledge and tools needed to navigate the financial complexities of running a business. Here's a recap of the key points discussed. 1. Understanding financial fitness for entrepreneurs. Financial fitness encompasses more than just keeping your business afloat. It's about strategic planning, efficient resource allocation, and the pursuit of financial growth and stability. The foundation of financial fitness lies in a comprehensive understanding of your financial situation, setting realistic goals, and implementing disciplined financial habits. 2. Setting financial goals. Goal setting is crucial for directing your financial strategies and measuring progress. Specific, measurable, achievable, relevant, and time bound SMART goals provide a framework for success, whether it's increasing revenue, reducing debt, or saving for future expansion. 3. Budgeting for business success. Budgeting is the process of creating a plan to spend your money, enabling you to determine in advance whether you will have enough resources to achieve your financial goals. Regular budget reviews allow for adjustments and reallocation of resources to align with business performance and objectives. 4. Revenue streams and diversification. Diversifying revenue streams can reduce risk and increase resilience against market fluctuations. Exploring new markets, products, or services can uncover additional revenue opportunities, contributing to the overall financial health of the business. 5. Cash flow management. Effective cash flow management is essential for the day to day operations of your business, helping you to ensure that you have enough cash to cover your obligations. Strategies include improving receivables, managing payables, and maintaining an emergency cash reserve. 6. Investment and reinvestment in your business. Reinvesting profits back into the business is a powerful strategy for fueling growth and innovation. Decisions about investment and reinvestment should be aligned with your long term business goals and financial plans. 7. Understanding and managing debt. While debt can be a useful tool for financing growth, it's important to manage it wisely to avoid over leveraging. Strategies include negotiating favorable terms, prioritizing high interest debt, and maintaining a healthy debt to equity ratio. 8. Saving and planning for the future. Future oriented financial planning, including savings and investment strategies, is essential for long term success and sustainability. Planning for retirement, unexpected challenges, and business succession are all crucial aspects of this planning process. 9. Tax planning and management. Effective tax planning can significantly impact your business's bottom line, saving money and ensuring compliance. Understanding tax obligations, leveraging deductions and credits, and seeking professional advice are key strategies. 10. Financial health checkups. Regular financial reviews are vital for assessing the health of your business, identifying potential issues, and making informed decisions. Key financial metrics to monitor include cash flow, profit margins, debt to equity ratio, and inventory turnover. This episode of Financial Fitness Money Management for Entrepreneurs aims to provide you with a solid foundation in financial management principles and practices. By understanding and implementing these strategies, you can enhance your financial fitness, drive your business towards greater success, and achieve your entrepreneurial goals. Remember, financial management is an ongoing process that requires vigilance, adaptability, and continuous learning. Stay informed and stay resilient, and let your financial fitness journey lead you to unprecedented heights of entrepreneurial achievement. Call to action, powering your financial journey. As we conclude today's enlightening journey through financial fitness, money management for entrepreneurs, I want to leave you with a call to action that could redefine the course of your entrepreneurial venture. The strategies, insights, and practices we've delved into are more than just theoretical concepts. They are the building blocks of financial empowerment and business success. I encourage you, as entrepreneurs and visionaries, to take these insights beyond the realm of passive listening. Reflect on how each segment applies to your unique business context, identifying one or two strategies from today's episode that resonate with your current financial challenges or goals. Perhaps it's refining your approach to budgeting, exploring new revenue streams, or setting more strategic financial goals. Whatever it may be, commit to taking actionable steps towards implementing these strategies in your business. The path to financial fitness begins with intentional actions and informed decisions. The journey of financial management and entrepreneurship is one of continuous learning and adaptation. As you apply these strategies discussed today, I invite you to engage with us further. Share your insights and experiences, challenges, and successes. Your stories not only enrich our community, but also inspire and guide fellow entrepreneurs on their financial fitness journey. Remember, the Full Time Hustler podcast is your companion in this entrepreneurial journey. You can find us on Spotify, YouTube, and our WordPress blog, where we continue to explore the realities of startup culture, financial management, and the myriad aspects of entrepreneurship. Here, you'll find a community of like minded individuals, resources to support your business growth, and insights to keep you informed ahead of the curve. Spotify, tune into our episodes for our audio fix on financial strategies and entrepreneurial insights. YouTube, watch our discussions, interviews, and tutorials for a visual and interactive experience. WordPress blog. Visit our blog for articles, resources, and a deeper dive into topics that matter to you. In signing off, I want to remind you that your entrepreneurial journey is as unique as you are. The financial strategies we've covered today are tools in your arsenal. Use them wisely, adapt them to your needs, and never stop striving for financial fitness and business excellence. Thank you for joining me on this episode of Full Time Hustler Podcast. Until we meet again, keep hustling, keep dreaming. Most importantly, keep taking those bold steps towards financial empowerment and entrepreneurial success.